wasting money on cures. Forgot how to fix myself. They say that time is free. Then why is it so precious? Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. Time is running out. Time is running out. Lately I've lost my track. I've sailed the deeper seas, hoping to find something to bring back better times. Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. But time is running out. 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 Time is running. Time is running out. But time is running out. What if my best days are over? They can be over. They can't be over now. Time is running out. What if my best days are over? They can't be over now. Time is running out. Time is running out. Time is running out.
Okay, I think we can hit. So welcome everybody. Sorry about the problem at the start there. I'm going to use my my normal laptop microphone. Okay, welcome. Let's do a session on balance of payments, and in particular today we're going to focus on the issues of current account deficits and current account surpluses. Just before we start, Jim's running some business sessions next week, 5 sessions lined up for people doing business as well as economics perhaps, and they start on Monday and run all the way through to the end of the week. So 5 half-an-hour sessions that can make a big difference to your studies. Okay, before we crack on, a quick reminder that we are indeed live after Easter at Portsmouth, in Bristol, Birmingham, London. Our courses, our Grade Booster courses are live, and they're great fun and also really useful, hopefully. And they kick off the week after next, 17th of April. And then we head to Bristol and Birmingham and then London for our final week. And by that time, of course, the exam is going to be quite close. The paper's on the 18th, 22nd of May and the 5th of June. Now, this topic today is really important. It's the balance of payments. In some boards last year, it did not appear on the advanced information, so that it wasn't tested in 2022, and I guess is highly likely to be tested in 2023. So I've got some challenging questions for you. As always, if you're watching live, please post your answers in the live stream and chat window. You have to be subscribed to do that. So hit the subscribe button if you want to contribute. If you're watching on replay, then all you have to do is press the pause button and you'll be able to take a few moments to think about the questions. And the answers will appear on the screen. So here we go. Let's make a start, please. I just want to take you through, first of all, the structure of the balance of payments. So this is really quite important because balance of payments is one of those topics that students don't always revise as thoroughly as perhaps they might. You need to know at A-level for year 13, you need to know the structure of the balance of payments in terms of the current account, which you probably did in year 12, and also the financial account. Let me just, if it's okay with you, spend 2 minutes with you collectively going through the accounts. So the current account is basically asking the question, is a country paying its way internationally with other countries? And it's made of 3 sections. One is trading goods and services, so exports and imports of cars and TV screens and tourism and travel. And it's the X minus N that you'll be familiar with in terms of aggregate demand. So the trading goods and services account. Then we have primary income, which is basically the interest, the profits, and the dividends from the assets that we own overseas, minus the outflow of those things from the assets that overseas people own in the UK. So it's primary income. And then secondary income is things like transfers, including overseas aid. And until recently, of course, the UK's net contributions to the European Union, although we are still paying into the EU. So the current account is basically the extent to which a country such as the UK is paying its way internationally. Are we exporting enough to pay for the imports alongside the investment income that comes our way? You can ignore the capital account. It is essentially tiny, it's meaningless. It includes things like debt write-offs, debt relief, which is a form of aid anyway, but the capital account is not tested at A level. But what is tested for sure is the financial account. Let me just quickly take you through that. So the financial account is basically capital flows. This is why the capital account is slightly a bit of a misnomer. But it's essentially the flows of international capital, financial money across borders. And there are 3 main flows. One is direct investment, including FDI. So many of you, for example, will have covered FDI as part of your development economics or your economic growth studies. That comes under direct investment, building of factories and so on. Portfolio investment is the huge cross-border flows in things like bond purchases and equities and so on and so forth, along with banking flows. You may have come across these. They're known as short-term hot money flows, money moving across borders looking for the best risk-adjusted rate of return. So you have 3 main financial flows: direct investment, portfolio, and banking flows. They all appear in the financial account. There is also something called the error account, or the balancing item, which is there to reflect mistakes, inaccuracies in the accounts. It's normally a few billion pounds or dollars each year. But then critically, the final thing is the change in official reserves. So this is just a way of balancing the accounts. If a country is still in the red, in the sense on the balance of payments, their reserves go down, and therefore you can balance your accounts. For countries in the plus, overall, their reserves go up. The IMF are in charge of changes in official reserves of gold and foreign currency. So critically, Nicola talks about, is capital flight because of the increase of hot money? Well, capital flight, great question there from Nicola. So capital flight is when investors take their money out of stock markets or bank accounts or property. Of course, property is illiquid. So capital flight would be a negative outflow on the financial account. And that's often a problem for countries suffering economic instability. Keep in mind, this is the structure of the account. They can get a little bit complicated, but basically, the top half says, are you paying your way internationally? And the second bit, the financial account, says, are you a net creditor or debtor in terms of investment flows? Now, the next slide, I think, captures the essence of the balance of payments. A country running a big current account deficit, such as the UK, well, they need to run a financial account surplus to balance their accounts. So there's a net outflow of money on trade, for example. You need to have a net inflow of money on the financial account, or their reserves will go down. At the bottom line, the foreign currency reserves will fall. Whereas, the next slide shows a country running a current account surplus, really good example would be Norway. They can run, because they're running a big current account surplus, they can afford to run a deficit on their financial account. And often it means they accumulate billions of dollars and euros in sovereign wealth funds, much of which they can invest overseas. Norway has the biggest sovereign wealth fund in the world. Moore says, does the balance of payments always have to sum to zero? And the answer is yes. It's an account. So the balance of payments of any country is always zero. But the issue is, how does it get there? Okay, so for many countries that run persistent trade deficits and that can't attract capital for one reason or another, those countries often run into what's called the balance of payments problem or crisis. And the crisis, in what it means essentially, is they run out of foreign currency. And if you're a developing country that needs foreign currency, they need dollars to buy medicines and food and energy. That is a problem, and that is why countries with a balance of payments problem essentially means a foreign currency crisis. They have to try and get in maybe an emergency loan from the likes of the IMF, who step in to provide emergency financial support. So that's the structure of the account. I think it's worth spending a few minutes on it before we get into some questions, because it's the sort of thing that you do need to know for the A-level, and it's highly likely to come up in some shape or form this year. Okay, let's move on. Let's think about some questions. There are 5 multiple choice questions for you. As always, please press the answer in the chat window. Which item is not included in the current account on the balance of payments? Which item is not included in the current account of the balance of payments? What do we think? If you can post your answers A, B, C, or D into the chat window, that'd be amazing. And the answers are flying in, and to a person, everybody is saying A. Let's just double check. The answer is indeed A. The balancing item appears right at the end of the balance of payments account to sort of equalize everything up. Now, these next questions get a little harder, so that was an easy one. Here's question number 2. Reducing the exchange rate, lowering the exchange rate, helps to decrease a country's current account deficit because it makes imports more expensive and exports cheaper. Now, what does that statement describe? What do we think for question number 2? Exchange rate depreciation tends to decrease a current account deficit because it makes imports more expensive and exports cheaper. What does this statement describe? What do we think? Most people are coming straight in. Again, good answers here. A few people saying C, expenditure reduction. In fact, the answer is coming up now. The answer is D. Fall in the exchange rate is a key example, please, of an expenditure switching policy. It changes the relative prices. It changes the price of exports. They tend to go down. Price of imports in the domestic economy go up. That creates a substitution effect, switching people's spending. Of course, the impact depends on the coefficient of elasticity of demand for exports and for imports. Here's our next question, question number 3. Now, this is a really good question from 2021, actually. The table gives different combinations of values for price elasticity demand for exports and PD for imports. Following the devaluation of a country's currency, under which combination would the country's current account actually worsen, not improve? There's only one combination where that would cause the current account, including the trade balance, to initially worsen following devaluation. Tom and Cleo and Shimaz, Jovni, Louis, and Dylan all saying it's going to be A. Let's double check. Yeah, and Drew is very quickly in with a comment. He really spotted it. The Marshall condition, right? Yes, exactly. Marshall condition is that the sum of the elasticities must be greater than 1 for a fall in the exchange rate to improve the trade balance. Well, add those two together, do the maths, 0.6. All the others just equal, just above 1, so they will improve the trade balance. The one that will cause the biggest change in the trade balance would be D, of course, because the sum of the elasticities there is 2.4. And can you visualize in your mind a J-curve diagram there? You could be able to use that in an exam answer. Robbie says, never heard of the Marshall-Lerner condition. This is super important, Robbie. You need to read up on the Marshall-Lerner condition. A currency depreciation, or in this case a devaluation, will worsen the trade balance if the elasticities are less than 1. If demand for imports and exports is price inelastic, it needs to be bigger than 1 in total for the devaluation to improve the trade balance. Super important, that. Number 4. Oh, I like this question. The table below shows information from the current account of the balance payments for Canada and Singapore in 2019, so it's quite up to date. There's the data in front of you. It's in the table. What can you conclude from the table? Take a moment on this one. You've got some data there on Canada and Singapore. What can you conclude from that data? A, B, C, or D? What do we think? Probably take a little bit of working out. Dylan says Excel has the J-curve. It certainly does. It's an important aspect of exchange rates and trade. Need to know the J-curve. Difference of opinions coming here. A few people saying B, a lot of people saying C. I think one person chose A, but a lot of people going for C. That seems to be the consensus amongst the Tudy2 student collective. Let's check the answer. It is indeed C. Well done if you got that right. Some people chose A in the exam. Canada exported more goods than Singapore. Well, it didn't. The data says that a lot of people think the trade balance is how much we export. It's not the quantity, it's the value of exports. And Canada's exports of goods were greater than Singapore in value terms. That's not the same as volume. Okay, next question. This is a harder one. And if you were listening as I went through the structure of the account, hopefully you can get this right. A resident of country X buys shares in a firm in country Y. The shares then pay the resident a dividend. Okay, where are these two flows recorded in country X's balance of payments? So purchase and dividend. So what do we think? There's two cross-border flows happening here. John and Charlie, I think, and Jay, I think C. A few people thinking D, actually. Quite a few people thinking D. Let's check the answer on this one, everybody. The answer is C. It's obviously on the financial account because it's buying an equity overseas. It's primary income. So if you buy shares, if I buy shares in Google, then if Google pays me a dividend, the income comes in on the primary income account for the UK current account. Okay, here's a nice little challenge for you. Let's see how good you are. Can you identify the export pattern for each of the following 5 countries? You might have played Wordle in the past. Well, let's have a go at Tradle. So for each country, I'm going to show you the pattern of exports just of goods, actually, not services, just goods. For 2021. I'll give you a couple of clues. Let's see if you can get the right answers. Clue one, it's number 5 export in the world. It's the 13th biggest economy in the world. It's a high-income country with a per capita income converging on that of Japan. On the left-hand side, it's what they export. On the right-hand side, to whom they export. So you've got the composition of the geographical. So what have we got here? The Riddler, one of our great contributors, thinks it's Singapore. Tutor to you, my producer upstairs, Jim, my sound engineer, thinks it's North Korea. Tom Manners and who else is Tom and Paddy and Chris Tyson have gone for South Korea. A few people going for Australia. Robbie thinks it's France, converging on Japan. A couple of people think it's Malta. Malta is not the 13th largest economy in the world. It's probably not even the 13th largest economy in Malta. Here's the answer coming up. Quite a few of you got it. Well done. It is South Korea. Fascinating country, high income nation with a per capita income close to that of Japan. Here's our next one. Try these ones. So our next one is coming up on the screen. Clue, it's a country on the African continent, heavily dependent on trade with the EU, as you can see in purple there. Invested heavily in renewables, which is likely to alter their export pattern in the future. Paddy thinks Algeria. Jack thinks Morocco. So does Josh. A lot of people going for Algeria. And quite a few people saying Rwanda. So Louis says Nigeria, based on the idea that the answer is always Nigeria. Musical Journey thinks it's Egypt. 5 more seconds if you want to post an answer in the chat window. Tom thinks it's the Congo. Quite a few people here think it's Rwanda or Nigeria. Here's the answer coming up. It is Morocco. So Morocco, heavily dependent, as you'd expect, I guess, trade with Spain. And critically, they have a nice mix of products in terms of their exports, but they are going to go large on renewable energy in the years to come, which could be quite a big change in comparative advantage. Here's number 3. Number 56th biggest exporter in the world. It's an emerging Asian economy, one of the most populous countries on the planet, with a huge export focus on textiles. Green is the color for textiles. Nason thinks it's Bangladesh. Quite a few people saying it's Vietnam or Indonesia. Aaron thinks it's Pakistan. And 1 or 2 others coming through. Cameron thinks it's Bangladesh. Taiwan, says Danny. emerging economy. Taiwan is probably now a high-income economy rather than an emerging economy. A few people saying Vietnam. Let's check the answer. Well done if you got it right, by the way. The answer is Bangladesh. Bangladesh. Fascinating example of an emerging market country with a very high export dependency on relatively low-value textiles. Can they sustain that? Can Bangladesh become rich just by making textiles? Fascinating question. Two more. Here we go. Well done by these. These are superb. Number 13 exporter in the world. UK has signed a trade deal with this country post-Brexit, and it's heavily dependent on trade with China. Now, Julia has 3 out of 3. So, Julia, the pressure is on. We'll be looking for your answer on the chat window. Has anybody else got 3 out of 3? Let us know. We'll give you a shout out. Over 300 people in the live stream as we speak. So thank you for everybody putting in. Tom thinks it's Australia. Adam and Nathan and Ines also agree. We've got a different one. Namer thinks it's New Zealand, which is quite interesting. Look at that dominance there. China, Japan, South Korea, essentially 2/3 of their exports go to just those 3 countries. So very heavily regional dependency there. Iron ore is their biggest export of goods. Chloe thinks possibly Cambodia. Eleanor thinks it's Australia. Here's the answer coming up. And the answer is indeed Australia. Really good example of a country that is so dependent on the Chinese economy for their terms of trade, export growth, and wider economic benefits. One more just for fun. Here we go. And then the 9th biggest economy in the world. Josh has 4 out of 4, so we're looking for Josh's. Can he get 100%? Signed a revised trade deal in 2018 with 2 of their most important trade partners. 73% of their exports of goods just go to the United States. What do we think on this one? Trade patterns, super interesting, I think. A Nation thinks it's Canada. Louis Robson thinks it's maple syrup. Just thought you'd drip that into the answer. Robert Galbraith thinks it's the Federal Democratic Republic of Ethiopia. Rob, you've got a superb wider knowledge of the world economy. Is it Mexico? No, thinks it could be Mexico. Or it could be, couldn't it? It could be. 73% of trade is with the United States. That is a really interesting example. Bertie asks, what's the website to look at these trade figures? The website is called the Observatory of Economic Complexity. My friend Cesar Hidalgo was the genius behind this. It is oec.com or something, OEC, Observatory of Economic Complexity. Monty thinks it's Canada, and Maxim thinks it's the Soviet Union. Well, the Soviet Union no longer exists. Here's the answer coming up. It is indeed Canada. Again, a fascinating country. Okay, let's focus now on the UK for a little bit, and then we'll get you to put in some answers. So just be aware of what the situation is with the UK. We run a trade deficit in goods and services overall. In fact, in 2022, our trade deficit in goods was £230 billion, which is staggering. Nearly £5 billion a week trade deficit in goods. But we had a record surplus in services, things like financial services, business services, of about £3 billion a week, maybe just a bit less. Overall, we had an 85 billion trade deficit. Now, that is forecast to get a lot bigger next year. So the forecast is that our trade gap in 2023 will be something like 4 times what it was in 2021. That's our trade position, okay? Which raises an interesting question. Why has the UK trade deficit got so much bigger? Over to you, everybody. A couple of people arriving late. We didn't miss much, certainly at the start. Here we go. Can you please give me in the chat window a reason why the UK trade deficit is getting much, much bigger? Over to you. As always, the 2to2 Collective are producing some superb answers. The Riddler talks about relative weak productivity compared to the EU and G7. That would be a terrific point, the Riddler, if you're focusing on longer-term supply-side causes, wouldn't it? The productivity gap is clearly one of those issues there. Chloe makes a really good point. We'll come on to that in a second. Chloe, about Brexit. Rob Galbraith, the COVID pandemic, Brexit and the food industry being badly affected by those. We might be able to bring Chloe's point up on the screen, which I think is a really super insightful point about Brexit. Here it comes. Deindustrialization and loss of comparative advantage. Those are long-term factors. She also mentions low productivity and Brexit making trade more difficult via increased bureaucracy. There we go, low productivity plus business investment due to a lack of confidence. If you get a question on the trade deficit, Chloe, you are in great shape. Aaron talks about high inflation, which means we're less competitive. Can I just pick out three for you? If you want to take a screenshot of this or you just want to add to your notes. There's no question in the UK that export growth has weakened in the last couple of years. Many UK businesses are now claiming that post-Brexit, we left the EU, of course, in January 2020, there are significant non-tariff barriers affecting UK trade. Lots of small businesses have basically opted out of trading with the EU. So I'd definitely be linking non-tariff barriers to the trade position. Of course, we have signed a free trade agreement with the EU, but it's the non-tariff barriers, things like product standards and paperwork, that seem to be acting as quite a bridge. Keep in mind also that the UK is a net importer of many essential things, gas, lots of food, and other things, the world prices of which have gone up in the last 2 years. And of course, we have a very low price elasticity of demand for those products. So we end up spending a lot more on imports. Exports subdued, import bills going up. There's only one way the trade deficit can go. And maybe this is maybe a point worth thinking about, the currency weakness. So some people talked about the budget fiasco back in September, Kwasi Kwarteng's budget. The pound fell quite sharply against the dollar and the euro. Many of the things we import are in dollars. And of course, in the short term, a weakness of the pound might worsen the trade balance. So the J-curve effect kicks in, because it takes time for exports to respond to the weaker pound. Okay, so that was pretty good. That's the trade balance. Moving on, here's the figure for the current account. I'm conscious that you may well get some data on the UK. So we looked at the trade balance. This is the current account, which is made up of trade balance. That's in blue. Investment income is that net flow of interest, profits, and dividends. That's in orange. And there's something called the employee income balance, which is basically remittances. Now, don't worry about, for the UK, inflows and outflows of remittances basically cancel each other out. So that's why it doesn't even appear on the chart. But transfers is things like overseas aid payments, maintaining payments to the EU, payments to international organizations such as the United Nations. That's always negative, by the way. But you can see that our current account has got a lot worse just in 2022 and 23. And the next slide shows this as a share, in terms of pounds, sorry. It's likely to be 155 billion pounds in 2023. It was very low, 34 billion in 2021, but then a big jump in 2022. So maybe the examiners are thinking about the increasing trade and current account deficit in the UK. Perhaps that will be an exam topic. In which case, oh, by the way, this next chart shows you as a share of GDP. A great stat to have for your revision. The UK economy ran a current account deficit of just 1.5% in 2021. That has quadrupled to forecasts of 6% in 2023. That's the highest figure of all time for the UK. It's the biggest current account deficit we've ever had, if that figure turns out to be true. Over to you, everybody. Can you think of some consequences for the UK of a large current account deficit? What can you come up with? Now, there's a super important point coming out of these answers, and a lot of you are saying a rising national debt, which is incorrect. The trade deficit, current account deficit, is not the same as the fiscal deficit or the budget deficit. So I think this is quite a useful session. If the UK is running a trade deficit, current account deficit, it does not mean that the national debt goes up. That only refers to the fiscal deficit and the accumulated borrowing of the government. So quite a few nice points. Leo Weicker has a nice point here about the loss of FDI, possibly due to a decrease in investing confidence in the UK. I'll touch upon that in Leo in a second when I go through my thoughts. iBoy 101 talks about cost push inflation from a fall in demand for exports. So currency depreciation raises the price of imports. Yeah, I'll talk a little bit about that. So weak current account can certainly cause the exchange rate to fall. Humphrey talks about capital flight. Interesting point here. Pressure on the sort of financial account, capital flight, and therefore currency crisis and potential economic crisis. Now that's interesting. I'm not sure what's going to happen to the UK, as I'll explain in a second. And lots of people talking about hot money outflows. Well, let me just go through my points here. This might be worth just pausing for a second and just taking a look at this one. Does a current account deficit matter for the UK? Well, on the one hand, yes, it does. First of all, it can lead to currency weakness because there's more money flowing out of the UK than flowing in. So the supply of pounds will go up and the pound will depreciate against the euro or the dollar over time. And of course, if the currency weakens, imports become more expensive. The thing we import, the gas, the pharmaceuticals, the food we import becomes more expensive. That can cause inflation, which is already high. And of course, that can hit real incomes. So on the one hand, linking current account deficit to a weak exchange rate to higher inflation is really good analysis. The second point is pretty year 12 stuff, but it does reduce growth. It's a current account deficit. It's a net outflow of money and income from the circular flow. So it's going to reduce aggregate demand. X minus M is negative. So it's a drag on short-term growth. And of course, that's made worse by the fact that inflation is high. So you could get some stagflationary effects. The third point is the most important point, and that is that you need to attract capital flows. So the UK is running a 6% current account deficit. You need to balance that on the financial accounts. So you'll need to attract financial inflows, portfolio flows, foreign investment, hot money. One way, not the UK, but the central bank could raise interest rates to try and attract those flows. Bank of England doesn't do that. It sets interest rates for other reasons, but countries could raise interest rates, which would have a consequence for growth and investment. Of course, you can also attract inward investment, FDI, and the UK does remain attractive to FDI for all kinds of good reasons, even outside the European Union. Although somebody mentioned, I think yesterday, the rising corporation tax could be a factor. 2 days ago, the rising corporation tax from 19 to 25% might make it a little harder for the UK economy to attract the inflows of investment needed to cover the balance of payments. Charlie asks, what is hot money? Great question, Charlie. Hot money is basically short-term banking flows. Investors around the world put their money in the bank accounts of countries which offer the best rate of interest. And that money can be moved around the world at the click of a button very, very quickly. So it's often the cause of currency instability. Okay, cool. Yeah, let's think about some other countries. We talk about the UK, just by way of closing. Let's look at another bit of data for you. Don't have to be data on the UK. It could be data on any country they want. So here are some sub-Saharan African countries with the largest current account deficits in 2021. Mozambique, 24%. Seychelles, 20%. All the way down to Uganda. All these countries have current account deficits of more than 10% of their GDP. So here's a question for you. Can you give me a reason why many African countries do run large current account deficits? What can you come up with? Okay, some really good points here about low productivity and weak sort of infrastructure. Sam Johnson talks about the lack of industrialization. That's a really good point, Sam. No country on the planet has ever really grown rich without urbanizing and industrializing first. And I'm going to link to that in a second, Sam. You're hinting there that they may be too dependent on primary industries, for example. Ryan talks about weak exchange rates. So if their currencies are weak, which of course could be a reflection of their deficit, that makes the cost of the things they import go up. Some really good points, actually. Arshan here talks about high dependence on developed countries to fund economic development. So, yeah, again, hinting at the fact that the trade, there may well be limited access to certain markets, to high-income countries. Many African countries have got favoured access, for example, to the European Union. Dhruv talks about, I'll just pick out Dhruv's point here, Dhruv Shah, they have poor infrastructure, hence they can't manufacture goods. This leads on to the Prebisch-Singer hypothesis. So really good point there, Dhruv, about countries that perhaps haven't developed the capacity and the capabilities to move beyond the primary sector. Their manufacturing sectors are relatively small and they haven't moved into higher value products. The example I always give is tomatoes. Growing tomatoes, you get a certain price. If you can process them and brand them, you get a much better price in the world market. Well, here are my points again, if you want to add to your revision notes. Often the case that African countries suffer big current account deficits because their key exports, which they're dependent on, fall in price. So if you think about Zambia producing copper, or Angola producing oil, or whatever it is, Ghana producing cocoa, if their main product, their main export falls in price, maybe in nominal real terms, that can cause their trade accounts to move sharply against them because the terms of trade have moved, they've deteriorated. It could be the case they're running a big deficit because they have to import certain things. Oftentimes, the deficit is a result of huge inward investment, importing of investment. So Mozambique, for example, is importing lots of capital today, this year, to fund its oil and gas exploration and drilling. So oftentimes, the deficit could be importing machinery, which might have a long-term benefit effect. Another point worth thinking about is the surge in overseas investments in many of these countries. So lots of developing countries have seen an inflow of FDI from foreign multinationals, and hopefully that adds to their GDP. But of course, a lot of the profits and the interests leave those countries on the current account as they're remitted to overseas countries. So there, a little look at some developing countries. Just to finish off with, everybody, I just want to take a slightly different slant and look at countries with big current account surpluses. So a lot of people revise the balance of payments and they only really consider deficit countries. Here's a chart showing the countries last year with the biggest current account surpluses in the world. Singapore, nearly 20% of their GDP. Norway, 15%. Ireland, 14%. And these are huge surplus countries. Germany, 7%. Look at China, not as big as people think. China is a big exporter, but it's only got a current account surplus of about 2% of its GDP, similar in sense to Australia and Japan. So here's my two questions for you to finish with. Let's see if you can come up with some great answers. Can you please give me one or two advantages of a country running a big current account surplus? What can you come up with? Okay, some great points. Really, really impressive stuff here. Arhan again is coming with a super point about where's Arhan's point? Might be good on the screen about the fact that it allows you to reduce your external debts. Really good point from Chris, actually. Chris Lewin talks about current account surpluses can shield a country from external shocks. So if you're running a big current account surplus and maybe your export sectors take a bit of a hit the world downturn, you've got like a macro buffer stock, which means you're probably better able to weather the economic storms. I think Ghana has introduced a macro stabilization fund. So during the good years, when they're reaping the export revenues from selling their products at high prices, they add that to a stabilization fund. And if the world economy goes into a little bit of a downspin and their exports take a hit, they can then inject some of that money into their domestic economy. Robbie has a point here. They have a strong exchange rate, which can lead to a growth in exports, leading to higher demand and growth, as well as attracting FDI. Yeah, a lot of FDI is attracted to successful countries. Base yourself in a successful country, and that can be a long-term growth benefit. Here are my 2 points coming up on the screen for you. If you're running a big current account surplus, you're generating more savings. These are dollars. Dollars are flowing into your country, or euros, or Japanese yen. So countries with the current account surplus can accumulate foreign currency reserves. Now, how they choose to use those reserves is up to them. Some countries might reduce their external debt. It's a good point. A couple of people made that in the live chat. Others might decide to invest overseas. So Singapore and Norway have big sovereign wealth funds. They can use those dollars to invest in overseas assets. And crucially, there's an obvious point, but it's worth making in the exam. If you're in a current account surplus, that's a net inflow of demand into your circular flow. And those profits can provide a flow of funds into the banking system, for example, or to fund corporate investment, the accelerator effect. Last question from me. Can we think about 2 drawbacks or 2 downsides if a country runs a persistently large current account surplus? Last question today. And this is evaluation, really. It doesn't necessarily, running a current account surplus is not necessarily a perfectly beneficial, advantageous thing. Musical journey. One of our regulars says demand pull inflation and countries can become very export dependent. 2 excellent evaluation points there. A lot of people's talking about Kagler talks about other countries might put up barriers against you. Toby talks about the Dutch disease as possible. Excellent. Chloe talks about the labour supply may not be occupationally mobile if they specialise and the industry fails. If you become over dependent on the industry. Some really, really good points. iBoy 101, let's just pick this one out, can lead to rising protectionism within trade deficit countries. So in the long run, that threatens globalization. That is, I think, one of the posts of the day. No question about it. That shows real insight. Partly because it links with what I'm about to say. Here are my 2 points. Drawbacks. 1, it can cause an appreciation of the currency, and other businesses, emerging manufacturing, for example, might suffer. You might want to think about the Dutch disease there. That's when think about Australia, for example. They have a huge surge in exports of iron ore. Great for their trade balance in the short term, but that drives up the Australian dollar, which makes Australia less competitive for making other things like solar panels and cars, for example. And critically, and it's point 2, some of you posted it in the chat, which is phenomenal. A persistently large current account surplus might invite a protectionist response from trade deficit countries. Now, this is where you can bring a bit of game theory in. Countries might get locked into a trade war, and that's the danger when you have big, huge trade imbalances between nations. Final slide for me, bit of overview, bit of exam gold. The trade data we've looked at, the trade patterns, the trade balances, they normally they say something about the underlying competitiveness of a country. So the fact the UK is running a big trade deficit tells us quite a bit about the supply side weaknesses, productivity, investment, and so on and so forth. Important to note that trade deficits normally have short and long-term causes, cyclical and structural causes. Be aware of those, because then you can apply short-term and long-term policies to the discussion. Supply side policies are really important, super important in the long run if you want to improve your trade outcomes. So in revision, make sure you've got some good examples of supply side policies that are specifically geared to driving exports and import substitution. It's probably the case that the era of hyperglobalization is under threat. What we are seeing now globally is a move towards regional trade agreements and bilateral trade agreements and a rise in non-tariff barriers. It looks as if the world economy is becoming more fragmented as we speak. A few thoughts from me there. Just before we finish, first of all, thank you for joining in. Apologies for the gremlins at the start. I couldn't get my sound organized properly. A quick reminder, we have our study companions. They are flying off the shelves. We have study books. Some people call them Bibles, but I call them study books, which there's 4 for each main example, an AQ and an Excel. You can get them from us, or you can get them from Amazon. If you've got an Amazon Prime account, you've ordered them today, they might be here tomorrow, who knows. Jim's got his business sessions running next week from Easter Monday onwards. I've got 5 sessions running next week as well. We're doing some synoptic revision tomorrow for paper 3 if you want to join us. As always, huge thanks to everybody who contributed to the live chat. The Tutor2 Student Collective is insane. It's nuts. Thanks, Emma, for your comments. Thank you. If you can press like, it helps other users find us. For some reason, I don't understand. But most of all, thanks for joining in. Hopefully it was a useful session. Stay happy, stay healthy, stay curious, and see you sometime soon.